Okay, welcome. Chapter 9, the cost of capital. Exercise 1, Chapter 9. A firm raises capital by selling $20,000 worth of debt with flotation costs equal to 2%. If we take the 2% from the $20,000, we end up with a float cost of $400. If the debt matures in 10 years and has a coupon interest rate of 8% paid annually, what is the bond's yield to maturity? We can see the yield to maturity formula to the right, where C will equal the interest rate, F face value. P is the price, but it's the face value minus the float cost, and N is the number of years. And if we plug the values into the yield to maturity formula, we end up with a yield to maturity of 8.3%. Let's move on to exercise 2. Your firm, People's Consulting Group, has been asked to consult on a potential preferred stock offering by Brave New World. This 9% preferred stock would be sold at its par value of $55 per share. Flotation's cost would total $3 per share. Calculate the cost of this preferred stock. The first thing you want to calculate is the net proceeds, and the net proceeds equals the par value of the stock at $55 per share minus the flotation cost of $3 per share will equate to $52. The next thing we want to calculate is the preferred stock dividend, which is simply the par value of the stock, $55, times the percentage, which is 9% the preferred stock issue has to offer per share of dividend, and that yields a dividend of $4.95 per share. Lastly, in order to calculate the cost of preferred stock, we take the preferred stock dividend and divide it into the net proceeds, which yields 9.52%. Moving on to exercise 3, Duke Energy has been paying dividends steadily for 20 years. During that time, dividends have grown at a compound annual rate of 3%. If Duke Energy's current stock price is $68 and the firm plans to pay a dividend of $6.50 next year, what is the required rate of return of Duke's common stock? For this problem, we're going to be utilizing the dividend growth model, where R equals the required rate of return, D is the dividend, P is the stock price, and G would be the growth constant. If we plug in the values for the dividend, the stock price, and the growth, we end up with a required rate of return of 11.33%. Exercise 4. Weekend Warriors Inc. has 35% debt and 65% equity in its capital structure. Remember always that the capital structure, when we calculate it for debt equity, must always equal 1. The firm's estimated after-tax cost of debt is 8%. Whenever we calculate the cost of debt, we must take out any tax effect. And its estimated cost of equity is 13%. Determine the firm's weighted average cost of capital. Once again, whenever we're calculating the cost of debt, we must take out any taxes. In this case, it's the after-tax cost of debt, so we can leave that alone. If we take a look at the weighted average cost of capital, abbreviated WACC, we see that it equals the weight of debt times the rate of debt plus the weight of stock times the rate of stock or the cost of capital of stock. If we plug in the values for the weight, the debt is at 35% and the stock is at 65%. And we multiply each by the cost, we end up with a total weighted average cost of capital at 11.25%. Exercise 5. In this exercise, I provided the weighted average cost of capital for the capital structure consisting of debt, D, S, common stock, and P, preferred stock. Oxy Corporation uses debt, preferred stock, and common stock to raise capital. The firm's capital structure targets the following proportions: debt 55%, preferred stock 10%, and common stock 35%. If the cost of debt is 6.7%, preferred stock has a cost of 9.2%, and common stock cost 10.6%. What is Oxy's weighted average cost of capital? Once again, all weights must equal 1. If we take 55%, 10%, and 35%, that should equal to 100% or 1. When we plug in the values of the weights and the cost of capital for each particular item in the capital structure, we end up with a weighted average cost of capital of 8.32%. Problem 1. The concept of cost of capital and weighted average cost of capital in Mace Manufacturing is in the process of analyzing its investment decision-making procedures. 2 projects evaluated by the firm recently involved building new facilities in different regions, north and south. The basic variables surrounding each project analysis and the resulting decision actions are summarized in the following table. Here we see north and south. The initial cost is an outflow of $6 million for north, $5 million for south. The life expectancy of the project is 15 years. The expected return for the north is 8%, and for the south is 15%. If we look at the source of financing, we see debt at 7% and equity at 16%. If we move back to the stipulations of the problem, we have A through F. A stipulates an annulus evaluating North facility expects the project be financed by debt that costs the firm 7%. What recommendation do you think the analyst will make regarding the investment opportunity? In B, another analyst assigned to study the South facility believes that funding for that project will come from the firm's retained earnings at a cost of 16%. What recommendation do you expect this analyst to make regarding the investment? And then C, explain why the decisions of Part A and B may not be in the best interest of the firm's investors. We'll start out with A through C. If we look at A, if the analyst expects a return of 8% and that costs 7%, then it should be accepted as Project North due to the fact that the return on the investment is greater than the cost. If we take a look at B, if the analyst expects to earn a 15% return on the South, they'll potentially reject it because the cost of capital can be relatively 16%. So the return less than the cost means it will be a rejected project. Finally, a suggestion is why not blend the different costs within your capital structure to find a weighted average cost of capital to better make a decision regarding to invest in the North or the South. If the firm maintains a capital structure containing 40% debt and 60% equity, find its weighted average cost of capital using the data in the table. From the data in the table, we can see the cost of debt being 7% after tax and the cost of equity being 16%. We never have to calculate the after-tax costs of equity, meaning common stock or preferred stock. We just have to calculate the after-tax costs of debt if it is not given to us. Taking into consideration the different weights, 40% of debt and 60% equity, we can now plug it into the weighted average cost of capital formula. In plugging the numbers into the weighted average cost of capital formula, we see the weights. The debt is at 40%, the equity is at 60%, the cost of debt is 7%, and the cost of equity is 16%. We end up at a weighted average cost of capital of 12.4%, which will give us a better indication of whether we should accept the North or the South project, or even both. Well, taking things into consideration, if we have a weighted average cost of capital of 12.4%, then really we should reject the North project and accept the South project with a return of 15%. The reason we reject the North product is the return is less than the weighted average cost of capital. Finally, we can conclude the minimal acceptable rate will reflect the weights associated with the target capital structure. And again, using the weighted average cost of capital 12.4%, we will accept the project in the South. Okay, let's move on to problem 6. The after-tax cost of debt. Bella Wands is interested in buying a new motorcycle. She has decided to borrow money to pay the $25,000 purchase price of the bike. She is in the 25% income tax bracket. She can either borrow the money at the interest rate of 5% from the motorcycle dealer or take out a second mortgage on her home. The mortgage would come to an interest rate of 6%. Interest payments on the mortgage would be tax deductible for Bella, but interest payments on the loan from the motorcycle dealer would not be deducted on Bella's federal tax return. We have 4 things to consider. We're going to calculate the after-tax cost of borrowing from the motorcycle dealership, A. B, we're going to calculate the after-tax cost of borrowing through a second mortgage on Bella's home. C, which source of borrowing is less costly for Bella, and should Bella consider any other factors when deciding which loan to take out. So when we calculate the after-tax cost of borrowing from the motorcycle dealership, there's really nothing we should do because the after-tax cost of borrowing from the dealership is the same as the pre-tax cost of 5%. However, when we calculate the after-tax cost of borrowing through a second mortgage, because mortgage interest is tax deductible, we have 6% times 1 minus T, as T is tax, the tax is her tax bracket is 25%, indicating that after-tax cost of the 6% through taking a second mortgage would actually amount to 4.5%. So the conclusion for which source of borrowing is less costly for Bella, the mortgage loan would be cheaper than the dealership loan. So what other factors when deciding which loan to take out should be considered? Well, number 1, will the home foreclose? Second, the mortgage loan closing costs are an added cost that are not considered in the motorcycle dealership's loan. And finally, the loan with the dealer, the downfall might be that the repossession of the bike for not fulfilling the loan obligation could occur. Problem 9. The cost of common stock equity, we can use CAPM. Netflix common stock has a beta of 0.8. The risk-free rate is 3% in the market, and the market return is 10%. They're asked us to determine the risk premium on Netflix common stock, determine the required rate of return the common stock should provide, and then determine Netflix cost of common stock equity using the CAPM model. As we can see from the CAPM model, the required rate of return equals the risk-free rate plus beta times the market rate minus the risk-free rate. Now, the market rate minus the risk-free rate is called the risk premium. So this area here is the risk premium. Plugging in the values for just the risk premium, beta times the market rate minus the risk-free rate, we end up with 5.6%. And all we have to do to add to that is add the risk-free rate. When we add the risk-free rate, concluding on the CAPM model of the required rate of return, we end up with 8.6%. So since there's no flotation costs, the common equity is equal to the required rate of return. And again, flotation costs are expenses a company endures when bringing a security to the market. There is a cost to that. And the cost is deducted when we're dealing with equity through the share price. In this case, there are no flotation costs, so the common equity equals the required rate of return. Problem 10. The cost of common stock equity, Ross Tiles, which is to measure its cost of common stock equity. The firm's stock is selling at a price of $70.67. The firm just recently paid a dividend of $4. The firm has been increasing dividends regularly. 5 years ago, the dividend was $2.99. After underpricing and the flotation costs, the firm expects to net $69 per share on a new issue. Underpricing indicates that the listing of an initial public offering called an IPO is at a price below its real value in the stock market. Underpricing. So in other words, when a new stock issued closes on its first day of trading above the IPO price, the stock is considered to have been underpriced. So we have a few things to consider here. Determine the average annual dividend growth rate over the 5 years. Determine the net proceeds that the firm will actually receive. Using the constant growth valuation model, determine the required rate of return on the company's stock, which should be equal to the cost of the retained earnings. And lastly, use the constant growth valuation model to determine the cost of a new common stock issue. So we're challenged with determining the average annual dividend growth over the last 5 years. And B, determine the net proceeds the firm will actually receive. A simple way to determine the growth of a stock rate over the course of a period of time, historically speaking, we can take the present value of the dividend, plug in the future value, and achieve a rough estimate going over 5 years of the rate. If we intuitively think of this, our future value would be today at $4, and our past we'll use as a present value. And we're going to solve for R using the future value lump sum formula. The first thing we must do is to isolate R to the right side. In order to do that, we divide by 2.99, and to get rid of the exponential number 5, over to the left, if we multiply both sides, on the left we have 1/5. So we have to do the division and take 1/5. Now, for 1/5, we can use our calculators to 0.20. So when we take a fraction, and we can take the whole fraction to the 1/5 power, we first calculate, we do the division, then 1/5 in the exponential, we'll put 0.20. Now we're going to subtract that by 1, and we're going to derive our actual growth rate of the dividend over the past 5 years, which is about roughly 6%. And if they ask you to round off to the hundredth, you just put 6%. To answer B, all we have to do is look onto the question and it gives you the answer, or net proceeds being $69 per share. So we're going to use the constant growth valuation model to determine the required rate of return of the common stock, which would equal the cost of retained earnings. When we plug in the values, and we have to remember, with the growth sitting at 6% a year, we have to multiply the dividend times 6%, divide it by the stock price, and then we're going to add the growth rate to it, and we're going to get a required rate of return, or the cost of common equity, at 12%. Since we're looking at determining the cost of a new share of common stock, that means a new issue, we have to add the flotation rate, because the investment banking company will require on a new issue, right, they will charge a commission, and that would be the difference between the issue price that the company wants to issue at, right, and the cost the investment bank would charge. Now, the investment bank could charge 5%, 10%, 8%, any percentage they want to bring the stock to market per share. So when we net it out, the net proceeds that the company will receive is the share price, they're bringing the stock to market, minus any flotation cost or commissions from the investment banker. And if we do the calculations, we end up with 12.14%. 12.14%. Okay, let's look at problem 14. We have book weights and we have market rates. Weights and rates. So we're going to calculate the weighted average cost of the book value weights and the weighted average cost of capital using the market value weights, and then we're going to compare the two. The example gives us a problem of the after-tax cost of long-term debt, preferred stock, common stock. And I'll be referring to long-term debt as LTD, preferred stock as PS, and common stock as CS. So let's start off with the book value, long-term debt, preferred stock, common stock. In order to get the weights, what we have to do is we have to add up our capital structure of long-term debt, preferred stock, and common stock, the value on our books, balance sheets. So if we take 4,000 divided into 4 million and divided into 5,100,000, we end up with a weight of 0.7843. If we take for preferred stock 40,000 and divide it into 5.1 million, we end up with 0.0078. And the same thing with common stock. We have $1,060,000. We divide it by 5.1 mil. And our weight for common stock is going to be 0.2078. And that's how we determine our weights. We add up all the value, dollars, within our capital structure, long-term debt, preferred stock, common stock. We get a total of 55,100,000, and then we just divide each of our elements in the capital structure by 5,100,000 to derive our weights. Next, we take our weights divided by the after-tax cost, and we see that long-term debt 6%, preferred stock is 13%, and common stock is 17%. When we multiply across, then add down, because we add all our adjusted weighted cost, our weighted average cost of capital for our book value would be at 8.34%. Now we're going to do the same thing when we calculate the market value of our company. We have long-term debt, preferred stock, common stock. These are at market values, current market values. And we have a total of $6,900,000. If we divide each of these capital structure elements into $6,900,000, we end up with our weights. Our weights multiplied by the after-tax cost will equal our weighted cost per capital structure element. For our market, our weighted average cost of capital would be 10.84%. 10.84%. And finally, the market value yielded a higher cost of capital, so using the book value would lead to accepting the project. Using the market value would not yield a positive return. Our last problem for today is number 19. We're going to calculate the individual cost of weighted average cost of capital for Lang Enterprises, because they're interested in measuring its overall cost of capital. Okay, so we have the following data. Lang Enterprises, very importantly, is at 21% tax bracket. We'll use that 21% tax bracket when we calculate the cost of debt. We don't use the firm's tax bracket rate when we calculate any equity or our retained earnings. So given the information in debt, the firm can raise debt by selling 1,000 par value, 8% coupon interest rate, 20-year bonds on which annual interest payments are made. To solve the issue, an average discount of $30 per bond would have been given, and the firm must have a flotation cost, the expenses incurred from issuing the bonds. Utilizing an investment banking company would be $30 per bond. So let's work on A. Calculate the after-tax cost of debt. Well, we're going to use the yield to maturity formula. Our years to maturity is 20. Our face value of the bonds is $1,000. Our proceeds, due to various factors, such as the bond discount and the flotation cost, so our net proceeds would be $940. And our annual interest at 8% with the face value of $1,000 would be $80 per bond. In plugging all the values into our yield to maturity formula, we end up with a yield to maturity of 0.8557, but that's before taxes. We must now utilize the firm's tax bracket and adjust the cost of debt because of the interest payment, which reduces the taxes paid by the firm. We must pull out that amount, and it ends up being, if we apply the formula, yield to maturity times 1 minus T, 1 minus the tax bracket rate, we end up with 6.67%. Next, we're going to calculate the cost of preferred stock. The first thing we have to do is calculate the net proceeds, which is the $95 per share, minus the flotation cost of $5, will equal $90. And then we have to calculate our preferred stock dividend. The share price is $95, and the company pays 8% on the par value as a dividend, which is $7.60. To calculate our cost of preferred stock, we take the dividend divided by the net proceeds, and we have a yield of 8.44%, which is the cost of preferred stock. To calculate the cost of common stock, once again, we're going to use the constant growth model. Our market price per share is at 90. Our dividends are at 7. Our dividend growth's at 6. Now, the stock was underpriced at 7, so from $90, we must deduct the 7, and we must deduct the $5. So we can see the net proceeds of common stock are the market share of $90 minus the underpricing, minus the flotation cost would be $78. We take the dividend, divide it by 78, plus the growth rate. We end up with a cost of common stock of 14.97%. We can also calculate the cost of retained earnings. Now, since retained earnings, it's what cash the company has available to make any type of purchases they need to. When we talk about capital budgeting within the future chapters, there will be no flotation costs or underpricing. It utilizes its equity-based dollar amount, and in doing so, we just need our price of our stock to be the market share price of $90, and our dividends at 7 with a growth rate of still 6% equals 13.778%. And finally, we're going to find the weighted average cost of capital of our capital structure using debt, common stock, and preferred stock. Once again, all the weights must add up to 1 or 100%. And we have our cost with our debt, and our debt is after tax debt, a cost. We have our cost of common stock and our cost of preferred stock. We multiply and add them and get a weighted average cost of capital of 11.2%.